Greetings, class, and welcome to the Chapter 12 Foundational 15 video. I'm going to start with some announcements. And the first announcement that I have is really about the exam number 3 and the corrections for the test. I'm grading these now, and I will be finished with them tomorrow. But what I want you to know is this. I'm going to I have an Excel workbook that I will be uploading into Canvas. It'll be very similar to what we use for Foundational 15. In this case, you'll have 20 questions that you can correct for. That's the multiple choice questions. And you'll go through each of these questions, and depending on what you got wrong, you'll explain what was wrong about or what you needed to do to correct the answer. And in those cases where you have a calculation that you need to make, you'll show me what the calculation is. So in other words, you'll go to the problem, you'll look at it, you'll say, okay, here's the calculation I needed to make, here is the correct answer, and you'll give that calculation to me in the workbook. So I know that all of you are going to have different problems in your exams. And so what I'm going to do is on Wednesday, I will open up the exam so you can look at it and see the results of the exam. You won't be able to change anything, but you'll be able to see the results of the exam so you can tell which problems you got wrong. And so those are the problems in the worksheet you need to address. However, if you're satisfied with your score on the exam after I get done grading, the first initial pass through, you don't need to do anything. If you're okay with the score you receive, you don't have to make any corrections unless you want to. Corrections will be accepted for the multiple choice problems. Because of the nature of the problems, I cannot do test corrections for those. So anyway, that's the test. That's the test corrections. That's how we're going to do it. You'll see the worksheet and the test will become available for you to work on those corrections on Wednesday. And so we'll go ahead and proceed from there. Now, for other announcements, I want to mention that we have a new discussion for this week. Be sure that you get in there and respond to these discussion questions. For the week ending April the 12th, this discussion is focused primarily on the exam. So you get to give your comments about that, and so we'll look at that. And then we're going to um, deal with well, we do have an assignment that's due as well, and this will be over Chapter 12, the differential analysis. It'll be available in the morning on April 14th, but it won't be due until a week from tomorrow. So you have 7 days to work on that. And that's the Chapter 12 differential analysis. And you can refer back to this video when you're looking at that and when you're doing those calculations. So discussion is due on Friday. The Chapter 12 differential analysis is due next Tuesday. That's on April the 21st. You will have test corrections available on Wednesday, and when they become available, you will have 48 hours to correct them. And once that window closes, the window's closed. So if you have any questions about that, be sure to let me know. So right now I want to go to this Foundational 15 video, or Foundational 15 problem that we are talking about today. And here is the problem. It's laid out in the document that's in the Chapter 12 module. I am not going to refer to this table here, but I am going to refer to this. So let's go to the Excel workbook. We begin with Kane Company manufactures two products called Alpha and Beta, and one of them sells for 120, the Alpha product, and $80 for the Beta. They each use one type of raw material that costs $6 a pound. The company has the capacity to annually produce 100,000 of each product, 100,000 units. its average cost for each product is shown below. And we have this broken out by direct materials, direct labor, variable manufacturing, traceable fixed manufacturing, variable selling expense, and common fixed expense. And then it says here, this is an important concept. The company considers traceable fixed manufacturing overhead to be avoidable, whereas its common fixed expenses are unavoidable and have been allocated to products based on sales dollars. So we're going to start this foundational 15. I'll look back here, and it asks, what is the total amount of traceable fixed manufacturing overhead for each of the two products? Well, in this initial calculation, we're basically going to look at this at our capacity. What is our capacity? So we're going to look at this traceable fixed cost per unit here. We have $16 for alpha, $18 for beta, and we have 100,000 units is the maximum capacity we have for each. And so we're going to compute this at this level. We're going to take the 100,000 times the $18, the 100,000 times the $16, and we have the total traceable fixed overhead for alpha is 1,000,006. The total traceable fixed overhead for beta is 1,000,008. So that's the answer to number one. In number two, they ask a similar question and they ask us, what is the company's total amount of common fixed expense? Well, here we're going to look back at this common fixed expense that they have on this line. We have $15 for alpha, $10 for beta. So we're going to put that in here first. We have $15 for alpha, $10 for beta. The level of activity in units, again, we're going to consider this at the maximum capacity. So 100,000 of each. And then we multiply 100,000 times 10, we get 1,000,000 for beta. 100,000 times 15, we get 1,000,005 for alpha. And in this case, we want to add these together because these are common fixed expenses, which means that in total, we take the pot and then divide it based on the sales value of those products. Okay. And then we get to number three, and we're going to ask a different kind of question here. Assume that Kane expects to produce and sell 80,000 alphas during the current year. One of Kane's sales representatives has found a new customer willing to buy 10,000 additional alphas for a price of $80 a unit. What is the financial advantage or disadvantage of accepting the new customer's order? So we're going to go back here. We're going to calculate this. So we get to sell these alphas instead of at $120, we're going to sell them at $80. So we're going to take the $80 times the order of 10,000 units. We get a total incremental revenue of 800,000. Variable costs, we have $30 per unit in direct materials. We get that from this chart right here. Direct materials of $30, direct labor of 20, variable manufacturing overhead is 7, and variable selling expense of 12. All of those costs are going to come into play in this calculation. So we take $30 times the 10,000 units, and we get 300,000. $20 here times those 10,000 units, get 200,000. We have $7 times 10,000, 70,000, and we have $12. Well, $12 here. We have $12 times 10,000. So we have a total then of incremental expenses of 690,000. Now, when we say incremental revenue and incremental expense, we mean the additional cost of taking on this order. It's incremental. So we're going to take the actual revenue that that order would produce and subtract out these additional costs, and we arrive at a financial advantage for taking this order of $110,000. Okay, so that's number 3. And then we come over here to number 4, and we're looking back here at the document. Assume that Cain expects to produce and sell 90,000 betas during the current year. One of Cain's sales representatives has found a new customer willing to buy 5,000 additional betas for a price of $39 a unit. What is the financial advantage or disadvantage of accepting this new customer's order? Well, in this case, we're going to go in to here, and we're going to look at the incremental revenue, which is going to be the $39 times 5,000 units. And with the beta, we're going to look back up here because we have different numbers. We have direct materials, direct labor, variable manufacturing overhead, variable selling expense. So we're going to have those costs we consider. So we have direct materials of $12. So we take that times 5,000 units. And then we have direct labor of $15. So we take that times, so we have 15 and we have that times 5,000 units. Then we have variable manufacturing overhead of $5. So we take that times 5,000 units. And then we have variable selling expense, and this is going to be $8. So we take that times 5,000 units. We get a total then variable cost here of $200,000. Now, when we compare the revenue that we're going to get from this of $195,000 with the cost that we're going to incur because of it, we see that we lose $5,000. In other words, this is going to be a financial disadvantage. So we're really not interested in taking on that additional order. Okay, for the next item, we have number 5 in the document. And here, the 5th question asks us, assume that Cain expects to produce and sell 95,000 alphas during the current year. One of Cain's sales representatives has found a new customer who's willing to buy 10,000 additional alphas for a price of $80 a unit. However, pursuing this opportunity will decrease alpha sales to regular customers by 5,000 units. What is the financial advantage or disadvantage of accepting this new customer's order? So we're going to go to the worksheet and calculate this again. So here, with number 5, the incremental revenue per item is going to be $80. And we're going to take that $80 times 10,000 because that's how many units we'll sell to this new customer. Now, when we get down to the incremental cost, we have to think about this because we're going to get an order of 10,000 units, but we're also going to, we have a limit of what we can actually produce. So we're going to take 5,000 units from our regular customers and then sell them to this customer. So we have to say, okay, the additional cost of manufacturing these will be the difference between what we are going to sell this customer and what we're going to lose when we don't sell these to other customers. So it's going to be the $10,000 unit sale minus the 5,000 units we have to cut back from regular customers. In this case, we're going to take the $30 per unit times 5,000. We have $30 per unit here. We're going to take 30 per unit times 5,000. We have $20 per unit here for direct labor. We're going to take that times 5,000. And we have variable manufacturing overhead of $7. We're going to take times 5,000. And then we have variable selling costs of $12 that we're going to take times 5,000. This total variable cost then is the additional cost that we're going to incur by taking this order on. Since we're giving up 5,000 units, we will not take on additional costs for those, but we have these, we're giving up the 5,000 units we've already manufactured, but we're not selling them to the regular customers, we're selling them to this customer. Now we have to think about, okay, what kind of sales are we giving up? We are normally going to sell these at $120 each. So we take the $120 times 5,000 units, and we're going to give up in revenue $600,000. Okay, that is an opportunity cost, but that's a real cost because we will not collect that 600,000 from our regular customers. Instead, we're going to be redirecting it as a part of this $800,000 order here. So what we want to do now is to take the $800,000 in incremental revenue minus the $345 in incremental expense minus a $600,000 in opportunity cost to get the net financial disadvantage that we're going to have, which is $145,000. This is basically looking at the problem and saying, okay, what differs between these two decisions? And the one thing that differs is the quantity of units we're selling and to whom. And so now we have a financial disadvantage for number 5. With number 6, we're going to look at a little different question here. This is going to be a question about discontinuing the beta line. Do we want to discontinue the beta line? So it says, assume that Kane normally produces and sells 90,000 betas per year. What is the financial advantage or disadvantage of discontinuing the beta product line? So we're going to come down here and calculate that. Now I'm going to start here because we want to calculate the contribution margin for these beta units. So we start with a sales price of $80. The variable cost is going to be the sum of the $12 of direct materials, the $15 of direct labor, the $5 of variable manufacturing overhead, and the $12 of variable selling expense. Or no, not $12, $8. I'm sorry, I got the wrong one. So it's $8 variable selling expense. That is the total variable cost that we have for this product, and we're going to subtract that from the $80 to get the contribution margin of $40 per unit. Now we're going to drop 90,000 units. So we want to calculate that. We're going to multiply 90,000 times 40. We get $3,600,000. And we're going to put that in up here as a lost contribution margin. So that's going to be a negative number, 3,600,000. Now, the traceable fixed manufacturing overhead is going to be exactly this cost that we calculated in the beginning, in number 1. When we came down here and we said, okay, what is a traceable fixed overhead? In total, it's 1,000,008. So since we're giving up the entire beta line, we're going to lose that entire cost. So that cost will be added back because we won't be spending that money, the 1,000,008. The net is the sum of these two. So we have a disadvantage, a financial disadvantage of 1,000,008, and that's because the cost we give up is not as much as the contribution margin that we give up. So that's number 6. Okay. Let's look at number 7, which is going to be very similar to that also. Now it says assume that Kane normally produces and sells 40,000 betas a year. What is the financial advantage or disadvantage of discontinuing the beta product line? So we go over here and we're going to calculate this. We say the contribution margin is what we're going to start with. So like we did before, we start with the sales price of $80, the variable cost of 40, and then we have the contribution margin of 40. Now we have the units dropped, so we have 40,000 units instead of 90. When we multiply this together, we get 1,000,006 as a contribution margin given up. So we're going to enter that here as a negative number. 1,000,006. We're losing that contribution margin, but we're also losing the 1,000,008 in traceable fixed manufacturing overhead. So we add the sum of those two, and we get the difference between them is actually going to be a $200,000 financial advantage to drop the beta line. So with this scenario, with the volume being different, it's actually to our advantage to drop that line because we are not incurring the traceable fixed manufacturing overhead anymore. Okay, then number 8, if we look at that one, it says assume that Kane normally produces and sells 60,000 betas and 80,000 alphas in a year. If Kane discontinues the beta product line, its sales representatives could increase sales of alpha by 15,000 units. What is the financial advantage or disadvantage of discontinuing the beta product line? So we want to go back and recompute this with additional information about the alpha. So we're going to start with the contribution margin per unit as we did before. So we take the beta sales price and then the beta variable cost, which we've computed, and that's direct materials, direct labor, variable overhead, and variable selling. So we'll take the difference between those and we get $40 as a contribution margin per unit. And then here, the units drop that we're looking at is going to be 60,000 units. So we're dropping 60,000. So our total lost contribution margin is 2,000,004 for beta. So up here, we want to enter a negative 2,000,004 because we're giving up that contribution margin. However, we are also going to sell some additional alpha products. So we take the alpha sales price, and then we're going to take the variable cost for alpha, which is going to be, I'm going to go up here, the variable cost is going to be direct materials, direct labor, variable overhead, and variable selling. So I'm going to go back down here and enter those in and add those up. So we have direct materials of $30. We have direct labor of 20. We have variable overhead of 7. We have variable selling of 12. So we wind up with $69 as a variable cost for the alpha. So we then take the 120 minus the 69. We get a $51 contribution margin. We're not dropping these units, we're adding these units now because we're going to sell 15,000 more units. So these are going to be added. So we're going to multiply the 15,000 times 51. We get 765,000 that's added. So we're going to have additional contribution margin here of 765,000. Oh, wait a minute. I put that in the wrong place. 765. Now we're also giving up the traceable fixed manufacturing overhead for beta. So I'm going to add that in here too. 1,800,000. So we're losing the contribution margin, we compute it here. We're adding the traceable fixed overhead, or well, we're losing that expense, so we're reducing the lost revenue by that expense, but we're picking up this additional contribution margin for the alpha. So the sum of all of these will give us the change or the financial advantage or disadvantage of doing this. So based on these calculations, the financial advantage of dropping beta is 165,000. So we would do that. That would be a decision that we would make. So now, when we look at the foundational 15 for number 9, we're going to look at a make or buy decision. This says, assume that Cain expects to produce and sell 80,000 alphas during the current year. Suppliers offer to manufacture and deliver 80,000 alphas to Cain for a price of $80 a unit. What is the financial advantage or disadvantage of buying 80,000 units from the supplier instead of making those? Well, when we come back here, what we want to do is we want to look at, okay, what will it cost us to buy those units? Well, we're going to take $80 a unit times 80,000. That'll be 6,000,004. That will be the total cost of buying the unit. So we'll spend $6,400,000 on buying the unit. So now what we want to think about is what will it cost us to manufacture these? And the only costs we're going to consider are direct materials, direct labor, variable overhead, and the traceable fixed manufacturing overhead. Because this traceable fixed manufacturing overhead is something we will give away entirely if we decide to buy. We have these costs now because we're making them. And by the way, the costs were in number 1, but it was the $16 times 100,000, which was at capacity, which will be $1,600,000. Okay, so that's a traceable fixed manufacturing overhead. For direct materials, we're going to take the $30 times 80,000 units. That's how many we're going to use this year. If we buy them, we're 6,000,004. If we make them, we have to take those 80,000 units, put in the direct materials. We'll also have $20 times 80,000 units. I need an equals sign there. So we have 1,006,000 in direct labor, and then we're going to have $7 times 80,000 units for variable manufacturing overhead. These are the only costs that we consider because these are the only costs that will go away if we decide to buy these. So we add these up and we get 6,160,000 for making, 6,400,000 for buying. And if we take the difference between these two, we see we have a 240,000 disadvantage to actually buying these units. So we should continue to make them in this circumstance. Okay, let's go down to number 10. In number 10, it says, assume that Cain expects to produce and sell 50,000 alphas during the year. A supplier is offered to manufacture and deliver 50,000 alphas to Cain for a price of $80 a unit. What is the financial advantage or disadvantage of buying 50,000 units from the supplier instead of making those units? Well, we want to come back here and do that same analysis we did in number 9, but with 50,000 units. So we take $80 times 50,000 and we get $4 million. So we're going to spend $4 million if we purchase these. Okay, if we make these, we're going to take the $30 a unit times 50,000. Again, equals, we get $1,005,000. Direct labor is $20 per unit times 50,000 units. Again, that's a million. And then the $7 for per unit for variable manufacturing overhead times 50,000 units, we get 350,000. The traceable fixed manufacturing overhead is going to be going to go in here as the entire capacity of the factory. So 1,600,000 is the traceable fixed manufacturing overhead because that's the factory at capacity. We add these up, we wind up with 4,450,000 if we manufacture these, but then we get 4 million if we buy them. So in this case, it'll be a financial advantage of $450,000 to buy these instead of make these. So that's a make or buy decision, and that illustrates what the difference in volume will do to a make or buy decision. Number 11 is going to go a little bit different direction now because we're starting to look at things where we deal with constrained resources. So with number 11, it says how many pounds of raw material are needed to make 1 unit of each of the two products. Now in this problem, they don't tell us how many pounds are needed for each product, but they tell us what the cost is. So we have direct material cost for alpha of 30, direct material cost for beta of 12. And they told us in this very beginning, if we go back here to the top, that the cost for raw material is $6 a pound. So what we're going to do now to answer number 11 is go back here and we're going to divide the direct material cost by the cost per pound to identify how many pounds of raw material each is going to use. So we have 5 pounds per unit for alpha and 2 pounds per unit for beta. Okay, so that's number 11. Now with number 12, we're getting into this idea now that we're dealing with a constrained resource and this material. So we want to look at what the contribution margin per pound of raw material is. And that's what number 12 asks us. What is the contribution margin per pound of raw material earned by each of the two products? So we want to start with alpha. We have the selling price of 120. We know the variable cost per unit is 69 because we calculated that right over here. Remember this? So we have then a contribution margin of $51. For beta, we have over here the $80 selling price per unit, $40 in variable costs, and we have a contribution margin of $40 per unit. Now, what we want to know is how much of a contribution margin per pound of raw material do we have in each. So we take the pounds of raw material that are used in alpha and the pounds of raw material used in beta, and we divide the contribution margin per unit by the pounds used for each unit. So what we do is we take the $51 divided by 5 and the $40 divided by 2. What you see here is that the alpha unit has a contribution margin per pound of $10.20, and the beta unit has a contribution margin per pound of $20. So now we're going to look at the optimal use of the constrained resource. Okay, number 13, we'll go back over here to this problem. It says assume that Kane's customers will buy a maximum of 80,000 units of alpha and 60,000 units of beta. Also assume that the raw materials available for production is limited to 160,000 pounds. How many units of each product should Kane produce to maximize profit? So we come over here and we say we have total 160,000 pounds available. And we know that based on this calculation right here that we have $20 contribution margin per pound for beta, but 10.20 for alpha. So we want to absolutely maximize all of the beta units we can. So they'll buy 60,000 units. We want to produce 60,000 units. If our customers will buy it, that's what we want to produce. Now we know we need 2 pounds of material per beta unit based on this calculation here. So what we wind up with then is we are using 120,000 pounds of raw material on the beta products. The difference is going to be what we use for the alpha products, 40,000 units. Now we know that for alpha, we're going to use 5 pounds per unit. And in order to figure out how many units we can produce, we just take the pounds of material we have left and available divided by the number of pounds per unit, and we come up with 8,000 units of alpha. That's what we can manufacture to maximize our profit. So the ideal here product mix would be 60,000 units of beta and 8,000 units of alpha. Okay. Now in number 14, we're going to come back here and look at this question. If Kane follows your recommendation in requirement 13, what contribution margin will it earn? Well, we go over here and we say, okay, well, how many units are we going to produce? Well, based on this, we're only going to produce 8,000 units of beta, but we're going to do 60,000 units of beta. I'm sorry, I said beta. We're going to do 8,000 units of alpha, 60,000 units of beta. The contribution margin for alpha, if we go back here, remember, is $51. So we're going to bring that here, 51. And the contribution margin per unit for beta is $40. So we do that here. We take the contribution margin per unit times the number of units. And we get 408,000 as a contribution margin for beta. 2,000,004 as a contribution margin. 408,000 as a contribution margin for alpha. 2,000,004 as a contribution margin for beta. So the total that we have is 2,808,000. That's the contribution margin if we maximize the raw material that we have. Now for number 15, it asks us, okay, if Kane uses the 160,000 pounds of raw material as recommended, up to how much should it be willing to pay per pound for additional raw materials? Well, the only other product we're going to be able to sell is the alpha product because we're already at maximum sales on beta. So we're going to go to the alpha. We're going to say, okay, our regular direct material cost per pound is $6. The contribution margin per pound of direct materials is $10.20. So basically, we're going to add those two together and say the maximum price that we want to pay for a pound of raw material would be $16.20. So that's number 15 in this foundational 15 for chapter 12.